Dark market secrets. Stock market bottoms are hard to spot. You can run any number of analytical tools, add trend lines, or your favorite indicators, and try to confirm data. But in the end, the bottom comes when the investors throw in the towel and have no more shares to sell. And the next major up move comes when a new fire hose of capital comes rushing in. This applies to tech, crypto, mining, energy, and every market sector. It's going to be a harsh reality and truth that once you're prepared for, we'll see the markets as they truly are, powerfully cyclical. And the dark market secret you'll learn today is one you won't find on stock screeners or nearly any newsletter you pay for. It's called shareholder turnover. Every publicly listed company has a shareholder turnover. For example, some investors from private rounds look for exits when the company goes public. There are other shareholders who may have been riding a speculative momentum and want to sell out when the catalyst materializes. Every investor buys a stock for a specific reason, and understanding the nature or the emotion of an investor is nearly impossible. For example, during a recession or when a bubble pops, the shareholders who are borrowing funds and using leverage, also known as margin, get under pressure and are forced to sell. They are forced to sell because the value of their collateral posted has also declined with the market, but the amount they have borrowed has not changed. The margin calls trigger selling because the holder of the shares must sell the shares to meet the margin call. Hence why Katusa research always says never use margin unless you're a very sophisticated professional. This in turn will cause selling pressure and results in the trigger effect. And it's called shareholder turnover. Why is shareholder turnover important right now? Right now, I think it's a safe argument that many investors are spooked at the potential of a structural shift in the markets. Why is this the case? A few key reasons. Rising interest rates leads to increased borrowing costs and slower growth rates. Political uncertainty and war leads to investors de-risking, also reducing positions. And of course, rising inflation, which leads to higher input costs and declining corporate profits. For those who have been reading my editorial for some time will know that I am a contrarian investor. When there is blood in the streets and no one else can finance companies, that's where I shine. So given that the market has been whacked recently, is this the true bottom? Time to jump in, or just the tip of the selling iceberg? Let's look at past major structural shifts in the market to see how trading and volumes today compare to the tech bubble in the early 2000s and the financial crisis in 2008. The first way we will examine where we are at is through the shareholder turnover ratio. And it's a pretty simple metric. Total shares traded in a period divided by the average shares outstanding in that period. Let's use Amazon during the tech bubble as the first case study. So you can see it moved up from, the 98 to early 2000. And the tech bubble, when it popped from 2000 to 2001, the total volume of shares traded during that time period was 4.3 billion shares. As you can see in the chart, the share price increased about 14 times. Then from the March pop of 2000, fell 94% in 14 months. The average number of shares outstanding during this period was 357 million shares. So using the formula that we showed you above, you go 4.3 billion divided by 357 million equals about 12. This means that Amazon shares traded 12 times the total shares outstanding in the company. The next chart you're looking at shows the share turnover ratio for the other household name companies in the tech bubble and financial crisis. More importantly, shows what the shareholder turnover ratio is in real time right now. So the chart you're looking at shows three separate time periods. Remember, the blue is the tech bubble, the red was the financial crisis of 2008, and the yellow, which has just started, is basically from March of 2022 to present. The metrics suggest that to put in a true bottom, a lot more stock is going to need to trade or turn over. Now, what about the depth finder, the dollar volume turnover ratio? Taking the above analysis that we just showed you one step further, we're going to dig into what's called the dollar volume turnover ratio. So you take the shares traded in the period times the share price during that period divided by the average shares outstanding in that period. This is important because it shows the actual amount of capital, the dollars, the real money required to churn over the stock. The ratios change slightly from those in the above chart, but the big picture remains the same. More buying and selling activity are required to put in a bottom if this is a structural change in the markets. We can look at the real-time example in Amazon for both the bull market melt-up in 1998 to 99 and the crash from 2000 to 2001. The dollar volume accelerated throughout 1998 to the end of 99 as dollar volume traded 17-fold the average market capitalization of Amazon through that period. Then, as you can see in the chart you're looking at, the bubble popped, shares declined quickly. Dollar volume was 13 times the company market cap through 2000 to the end of 2001. So to move up takes a lot more. You remember, you're fighting gravity. It took the ratio 17-fold to get to its high, and to get to its bottom, where it plateaued, was 13 times its market cap. So let's check the dollar volume share turnover with some other big names. The chart you're looking at next is the dollar volume analysis for Microsoft, Amazon, Apple, JP Morgan, and Bank of America through two of the each last two major declines. So that's the chart you're looking at right now. Again, the blue is the tech bubble, the red is the financial crisis, and the yellow is the March 2022 to present. And you can see the same thing. We are nowhere near the total turnover ratio. Meaning, this one quick metric would say, if we're going to go lower, we have nowhere near the bottom. Profit and loss. The true economic impact of the structural shift is shown through the profit and loss. The share price performance of the past two major structural shifts has been wealth crushing. Past results are never a perfect indicator of future returns, but for many stocks, the current share price decline is nothing like those witnessed during the tech bubble or the financial crisis. You can see this chart of Microsoft, Amazon, Apple, JP Morgan, and Bank of America. You can see that the banks obviously struggled during the 2008 financial crisis. The tech companies, you look at Microsoft, went down over 60% during the tech bubble crash of 2001. Amazon, over 94%. Apple, over 70%. So looking at where they've declined now, again, its share price is nowhere near its lows in the previous cycles. So this leads to one critical question. Where is the new capital going to come from? Amazon faced a similar issue back in the 2000s, but as we know today, Amazon has attracted an enormous amount of capital from passive funds and drove its share prices to all-time highs. If you're a commodities investor or a crypto investor, you have to ask yourself the question, where is the new money going to come from and into the sector to take the shares higher? Many sectors are exhausted and continue to rotate, but are nowhere near the previous ratios of rotation. So, what new up-and-coming sector is money flowing into right now, you may ask? Two major ones. One you see in the headlines and trends right now, and that's oil stocks at multi-year highs. And the other is a sector you've probably never heard of outside Katusa research. It's carbon, and it's attracting boatloads of capital, and nobody is talking about it. So if you're late to the rotation and didn't get defensive last year, consider becoming a subscriber to the KRO. In the latest issue, we put out all of our portfolio companies through the share turnover tests. Have you done the same for your stock holdings? Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.